want a piece of capital that produces money, because at this end game, I don't think we're going to go back into fiat. I don't think it's going to be possible. We're going to have to deal in gold and silver for as long as it's going to take to rebuild trust in some kind of credit derivative of gold and silver. But it's not like people are going to immediately go back to paper, because like, look what just happened. It's going to take a long time. And in that time, you're going to want to have companies that can produce gold and silver and pay you dividends in the money that's going to be for the world at that time. Start worrying about the dollar. Like, when the dollar is run by a bunch of central bankers that have different ideas and they're all getting nervous, then that's when the dollar is shaky. It's a coincident indicator. It's not leading or lagging. It's like when the central bankers get nervous, the dollar is getting a little bit shaky.
When fiat money finally loses credibility, paper promises won't cut it anymore. The real power won't just lie in holding gold and silver. It will belong to those who control their source. Rafi Farber envisions a monetary transition where simply owning precious metals may not be enough. What truly matters is ownership of the productive assets that generate real money. In his view, once the current fiat system breaks down, society won't quickly revert to trust-based paper currencies. Instead, there will be an extended period where trade is conducted primarily in hard money, gold and silver, until a new credit system can be built on a foundation people trust. This perspective is grounded in historical reality. The US dollar, now assumed to be valuable, only gained legitimacy because it was once fully redeemable for gold. Convertibility was the anchor of confidence. Today, however, every fiat currency in the world ultimately relies on the dollar as its final backstop. If the dollar fails, there is no deeper reserve to fall back on, no global mechanism to absorb the shock. Unlike past resets, there will be no stronger paper currency to peg to. Only gold will remain as universally recognized settlement. Farber pushes this logic further to challenge widely held geopolitical assumptions. While many believe China will rise to monetary dominance in a post-dollar world, he argues the opposite. Much of China's perceived wealth is denominated in US dollars and dollar-linked assets. If the dollar collapses, that stored value evaporates instantly. And because capital in China is heavily restricted rather than freely deployable, even its domestic financial system lacks the flexibility needed to adapt. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue bringing you sharp insights and expert perspectives on gold, silver, and the forces reshaping the financial landscape. Thanks for watching.
I want a piece of capital that produces money. Because with this end game, I don't think we're going to go back into fiat. I don't think it's going to be possible. We're going to have to deal in gold and silver for as long as it's going to take to rebuild trust in some kind of credit derivative of gold and silver. But it's not like people are going to immediately go back to paper, because like, look what just happened. It's going to take a long time. And in that time, you're going to want to have companies that can produce gold and silver and pay you dividends in the money that's going to be for the world at that time. I don't think that people get duped and you convince them, and like some speech by some politician on CNN or whatever convinces them, oh, we're going to try this credit derivative and it's going to work. It's not that people get duped in that way. The dollar built itself on many decades of legitimate commerce. In the 19th century and early 20th century, and it was convertible. You could go to any bank and get your gold for your dollars, and there were problems, but they weren't as big as now. So for example, when Germany and when Weimar was, let's say, duped by the Rentenmark, they weren't, because ultimately it went back to dollars, and through some kind of derivative chain, the Rentenmark was saved by the dollar. But when you're talking about the dollar itself falling, there's no other derivative to build a system on, because that is the base credit derivative. Again, reserve currency. When that falls, it's not a matter of not being able to dupe. If you look at the pyramid and then you take out the second layer of it, what are you possibly going to build a credit derivative based on? What? It can't be the dollar. It can't be anything else. It would have to be gold. So you'd have to have a currency that has been traded convertible to gold for long enough that people would actually say this is a convertible currency, because people are going to be so sick of paper money and derivative credit for after this goes to hell. They're going to be sick of it. And they're not going to want to go back until I would say a full generation, maybe 20 years that we're going to be trading money. And that's really going to slow things down. It's going to change life as we know it. I think it'll be okay, but it'll be very different from what we know now. Yeah, you can't. It's not possible. All fiat currencies today are based on the dollar. That's when any country hyperinflates, what do they do to restabilize themselves? They repeg to the dollar. That's exactly what Israel did in 1985. It's exactly what every hyperinflating currency does. That's what Argentina is trying to do right now. They just did a $20 billion currency swap. That means that pesos are backed by dollars. That's what it means. That's a currency swap. This is how the dollar prolongs the hyperinflationary process in every country. But there's nothing that can prolong the hyperinflation of the dollar itself, except for the fact that it occupies that space as the reserve currency. That's the only thing that's stopping it. But once that goes, everything happens very fast. So yeah, what exporting inflation does is it delays the inflation. Well, when I say inflationary, I mean rising consumer prices. It delays the effect on rising consumer prices because you're exporting all those dollars outside your country, but they're still there. And when they will be sent back because China doesn't use dollars. They use yuan. That's their currency. So they have no direct use for dollars within their country. So then when the dollar is losing value, the best they can do is send it back to the source. And every country will do that at the same time. So yeah, all of the delayed inflation that the United States never experienced all comes to its door in a sudden flood of reversing the whole reserve currency situation has to be reversed. And it's not going to be gradual. It's going to be very sudden. Yeah, this actually is in my research. I was pointed to a video by Phil Lowe of the Bitter Draft of a Chinese man explaining why China is actually going to be one of the poorest, or the poorest, biggest country in the world once this monetary system resets, once the dollar collapses. People want to believe, or the orthodox opinion is like, well, China's supplying all the goods, they're going to be fine. But it's not going to be that way, because the wealth that they've been stacking, which is basically US dollars in their basement, the US dollar itself, if that dies, then all of the wealth that they stacked is no longer worth anything. So then what do they have? And his point in this video that he made was that imagine if you have all this capital, but it's locked behind a door and you can't get in it. He used the example of a grain silo, but nobody can get in the silo to use the grain. And if you try to get into it, the government will kill you. So that's what it's like in China. Like they have capital, but they're not allowed to do anything with it because they have this crazy mercantilist idea that all you have to have is the capital that just sits there. And then that's your wealth. And then the government doesn't let you use it at all. And then you're supposed to just be wealthy. So they have this like infantile idea of what wealth is. You could say all Keynesians do. But then the vehicle of that wealth, right? It's just like logging in and looking at your stock portfolio and you see a certain dollar amount. But then how much of that is inflated valuations? You don't even know because the yardstick is all messed up. So in China, the government has been like basically forcing people into investing their savings into housing for decades. So what happens if everybody's doing that because they have to, and then all of a sudden housing prices fall? So everybody it's not that everyone suddenly becomes poor. The fact is that everyone's revealed to never have been rich in the first place.
Rafi Farber makes it clear that monetary confidence isn't found in spreadsheets. It's found in human behavior. The real indicator of dollar strength isn't the DXY index, inflation reports, or policy speeches. It's whether central bankers appear composed or panicked. When the people with their hands on the levers start moving nervously, cutting rates into rising inflation, or contradicting each other in public, the illusion of control fades. The recent strain in the repo market proves this point mathematically. If $2.9 trillion in cash is being borrowed nightly while only $2.7 trillion in reserves exist, someone is passing around the same dollar twice. This fragility isn't just a short-term liquidity issue, it's structural. Farber argues that ever since paper money was severed from gold, the financial system lost its ability to settle anything. Debt no longer gets paid, it only gets refinanced. The entire global economy has become one long chain letter rolled forward decade after decade. The dollar sits at the top of that pyramid as the ultimate settlement layer. If that layer cracks, If gold suddenly revalues sharply higher and exposes the dollar as unbacked, the chain breaks. Let's get back to the interview.
Start worrying about the dollar. Like, when the dollar is run by a bunch of central bankers that have different ideas and they're all getting nervous, then that's when the dollar is shaky. It's what do you say? It's a coincident indicator. It's not leading or lagging. It's like when the central bankers get nervous, the dollar is getting a little bit shaky. And if you want to do an interesting research project, I've done this before. Look into the Federal Reserve website, and they have old transcripts from the 1970s and early 1980. They have transcripts word for word, not the minutes. They have the minutes too, but every word that was said, dialogue between Volcker and his little minions, what they were saying. They were like nauseous in late 1979, early 1980. They had no idea what to do, and they were all freaking out and asking Volcker for leadership and just to calm them down. So that's what the Fed is stepping into now. They are forced to cut into an accelerating consumer price inflation environment, and this is making them nervous because they know it can't work. But there's nothing else that they can do, because if they don't, the banks are going to collapse, and if they do, the dollar is going to collapse, and they're headed into that choice now. That's where they're going, and they know it, and they're getting nervous. Yeah, it's above 3%, so they used to talk about something called symmetrical inflation, where you try to get it above because it's been below too long. You haven't heard that word come out in the last few years. Haven't heard anything about symmetrical inflation at all. This takes me to they're running out of academic excuses because they know that people are suffering. I mean, the rank and file, average Joe type of American is not going to have that much savings, and he's going to be really hurt by these price increases, and they are being hurt. And there's really nothing the Fed can do about it right now. And since they're out of their techno babble, macroeconomic, econometric excuses for what's going on, this is where things get visceral and things get a little bit scary for them. And with Trump on the attack also, they're being attacked from that direction. I'm not saying the attacks on them are good or bad. It's just, I wouldn't want to be a central banker right now. I kind of feel bad for them, but I don't. It's like when your enemy finally gets his comeuppance and you've been thinking about it for a long time. When you see it happening, it's like, it's not so nice, but there's nothing you can do. But you're on the other side, and that's good. You made the right choices, and now you just have to live with watching other people fall, including central bankers. And all right, I enjoy it with maybe 5% of my, Schadenfreude type of personality, but mostly it's just sad.
And how does the repo market play into this? I know you recently made a post on that saying that things could really be coming to a head at the end of this month.
I'm not even sure the Fed understands this. It's a matter of basic arithmetic. It's not that complicated. I see these articles over and over, like they're saying, what's the amount of reserves that is ample or appropriate for the banking system? Well, it used to be zero because the repo market wasn't really a big thing. But then once 2008 hit and they had to buy all this dead debt, and then all that dead debt turns into reserves, which they have to keep cycling through to keep the balance sheet big. So you have all this ghost debt that can no longer be paid back, but it lubricates the pipes inside the main aorta of the banking system. So the basic arithmetic goes like this: it's that there's $2.9 trillion being traded every night between banks for reserves in exchange for treasuries, and then you come out and one of the Fed members said, well, I think the appropriate number for reserves is 2.7 trillion. I don't think we're going to hit any problems until 2.7 trillion. But I look at that, I'm like, seriously, you're going to say that in public, 2.7? But then what about the 2.9 trillion that are being traded every night? How does that work? How do you trade $2.9 trillion every night with 2.7 trillion in reserves? This doesn't, the math doesn't add up. There's $200 billion missing. So what do you say to that? Either they have no idea what they're talking about, or you can trade more than the amount of reserves in the system every night through some kind of mechanism that I've never heard of and I don't understand. Maybe. I don't think that's going to happen. But the point is that reserves are now like 3 trillion, almost 3 trillion flat, because the Treasury has been raising a bunch of dollars, and they get that from bank reserves. And reverse repos are now basically zero, so nothing can come from that box of money back into the bank system. It's pretty much empty. So, when we hit September 30th, which is only 5 days from now, when repo generally spikes for whatever regulatory reason that it doesn't even matter, but it does every quarter end. So we're probably going to have repos above $3 trillion in volume with reserves below that. So what happens is that you have to bid higher for repo cash, higher than they want to control interest rates for. So that's what happened in the repocalypse. That's what I think is going to happen now. If you have more repo trading volume than you have reserves, I mean, there could be a mechanism I just don't know about, some kind of magic money box that exists somewhere that I never heard of, but that's what I think is going to happen. I think interest rates are going to go up next week. Right? All the inflation that has been created since the dollar became the reserve currency is all still there. Debt from the 1950s and 60s, it's all still there. Why? Because it has to be rolled over. It can never be extinguished because we're not on a gold standard. There's no debt can be extinguished. This is what Keith Weiner talks about a lot, that without gold as the money or as the statutory money, I know it is money. I know naturally it is, and it still is. But without gold as the final extinguisher of debt, debt can only be rolled over. You're forcing yourself into a Ponzi scheme. There's nothing else you can do. So all the debt from the 1930s, 40s, 50s, ever since the dollar and gold were no longer convertible, it's all still there. It's in the form of bank reserves just rolled over decade after decade after decade, and it's all going away. And it goes away when it gets devalued against real money, which is gold. And then all those trillions of dollars of debt held by every country, all the trading partners with the dollar at its base. It's all one banking system controlled by different little central banks all over the world, but basically one banking system with the dollar as the reserve currency and gold underneath the dollar. And then when the dollar falls, all the currencies on top of it fall. And the entire banking system of the entire world that has now the dollar as the reserve currency, they all fall, everything.
The looming monetary reset isn't just about inflation or policy errors. It's the unraveling of a decades-long illusion of solvency. Every currency depends on the dollar, and the dollar itself is propped up by unpayable debt that has been endlessly rolled over since gold was removed as the final settlement layer. Central bankers are cornered, repo markets are straining against basic arithmetic, and political pressure is exposing their limits. Once trust in paper evaporates, there will be no higher currency to retreat to. Gold will reassert itself as the only credible anchor, and everything built on top of debt-based fiat, currencies, banks, even perceived national wealth, will be marked to reality. In that world, the winners won't just be those who hold real assets, but those who produce them. If the entire financial system is built on debt that can never truly be repaid, what happens when confidence finally shifts from paper promises to tangible value? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support and enjoy the video.